Again, somebody who's virtually flown the skies would be appearing right on your screens. If we talk about can active funds continue to generate alpha, or is it time to shift to the passive funds? Well, to get an answer to this very pertinent question, we would be joined by Vinay Paharia, the CIO from Union MF. Well, to talk about him, Vinay's professional stint has been spanning across more than 18 years, and he's worked with Invesco Asset Management as fund manager, equity in the past. Vinay, if you're all set, we are ready to hand it over to you. Let's greet him with a good round of cheer. It doesn't matter, physically or virtually. I think, as I said, we are connected, right?
Thank you. Thank you, Cafemutual, for giving me an opportunity to talk about this very special edition of analysis which you would want to present. So the topic for me is are active funds relevant for the Indian market? We are keeping it specific to the Indian market. So I think that there is quite a lot of debate around this topic, and especially the debate has only increased in the last 1 to 2 years. There have been headlines like this plastered across various media streets. We have seen a lot of active mutual funds taking a beating. Some of the people have questioned the future of active funds, and passive has of course done very well. The total passive assets have gone up substantially globally, and of course it's happening at an increasing pace in India as well. So the idea of this research was to reflect on data on whether active mutual funds indeed have added any value, and where do we go in this debate on active versus passive. So I think the reason for this debate is, of course, we have seen various studies which said that active funds have completely underperformed the markets, and we have seen various categories being analyzed. So, for example, the data on your screen is the performance of various active funds categories as on a particular day. So as you can see, the way to interpret this data is, for example, for example, 29% of all schemes have done better than the benchmark over a 5-year period, which means effectively 71% of the schemes underperformed their benchmark over a 5-year period as on that particular day. So that is as on 30th September 2021. So this data clearly shows that most active funds have underperformed, and this is one of the big reasons why we have seen a lot of these press headlines. But is this the correct way, and what is the problem with this analysis? I think this is one of the biggest problems with this analysis, and this is what we call as the snapshot analysis. So what we are doing is effectively just looking at the performances as on one particular day. So just imagine, let's use an analogy to understand the problem with this. Imagine that you are a quality inspector hired by Indian Railways. You have to judge the punctuality of a train that has 250 stops along the scheduled route. You board the train from one of these stops and alight it at another stop, and the train is late by 30 minutes by the time it reaches your stop, and you conclude that the punctuality of the train service is poor. What's the problem? The problem is that you have analyzed only a fraction of the outcomes. Punctuality on one stop on a given particular day across and ignoring the other stops. So what's the solution? The solution is we apply a different approach. We look at a comprehensive analysis of the entire data. We conduct a detailed study of punctuality on each of the different possible stops. So, for example, you learn that on any one particular day, on an average, the train is only late by on 50 of the 250 stops. On, let's say you boarded the train, there was a minor accident on one particular day, and hence that was an outlier, so on and so forth. Hence the train service may actually be superior than what you would have earlier believed if you analyze the entire spectrum of data. And hence the solution is comprehensive analysis of data, which is what we present. So the way to look at this is, and how to apply this to mutual fund performance is, of course, there are 250 typical trading days. An investor can invest on any particular day and not necessarily on one particular day in which you have analyzed the data. And hence, the solution to this entire problem is to look at rolling returns. What we need to analyze is how does returns look like on a daily rolling basis over a 1 year, 2 year, 3 year, 5 year basis. And that should give us a complete picture of whether or not the overall funds have done better or worse. So this is what the outcome is. This is a fairly comprehensive analysis of all the funds which are available or with a 5 year plus track record. So we have analyzed all of these schemes over a 1 year, 3 year, 5 year track record. Clearly, what comes out is, if we look at the daily rolling return data over a 1 year, 3 year and 5 year period, you would observe that significant number of schemes have outperformed their respective benchmarks. We have used their respective benchmarks for those respective categories. And remember, we have analyzed regular plans, the ones which are generally taken up by most of the customers. And clearly, the only one category which seems to have struggled is the large cap category. All the other categories of schemes over a 3 year and 5 year period have done reasonably well compared to their respective benchmarks. And why does this happen? We try to understand, is there something special about Indian market compared to, let's say, a US market? What we have also observed is that there is significant dispersion of returns among individual stocks in India. So for example, we have tried to analyze BSE 500 constituent companies and compared them to S&P 500 constituent companies in America. What did this, and we did this from calendar year 2017 onwards every year till calendar year 2021. So what we observed is that there is a significantly higher deviation in annual returns of BSE 500 constituents compared to the S&P 500 constituents. And the extent of deviation is also high. So while, let's say, for example, the average returns appear similar, look at what happens to the standard deviation. The deviation of returns compared to the mean is significantly higher. Also the kurtosis, which clearly highlights the dispersion of returns, is also very, very high. What it simply means is there are opportunities to make positive or negative alpha in Indian markets, and probably that's one of the reasons why there are opportunities, more opportunities for stock in India compared to the developed market like America. So broadly, the way to look at this, and we would want to highlight is summary, is that the prevalent single date analysis clearly indicates active funds have underperformed, and most of the time what we tend to look at reports are just like year-end reports, March 31st reports, etc., etc. And most of these reports are a single snapshot period reports, and hence they're less reliable. As we have highlighted, the better way of analysis is that is to look at rolling returns. Clearly, this eliminates a lot of biases, provides a much more reliable insight in appraising fund performance. And our analysis of this data for Indian in the Indian context is that that except for the large cap category, almost all the other categories have done well. So I think that's the broad view. Even in the large cap category, almost 48% of the funds have actually outperformed their benchmarks. So if one has to look at the overall scenario, it's clear that yes, active funds have done well, but a very important and pertinent point to note is that it's futile to engage in this debate because it's actually not active versus passive. It is active and passive. Without passive funds, there would not be any active funds. And without active, there would not be any passive. For the simple reason, assume that everyone in the world invests in passive funds. Who will decide the price discovery? Let's say there is war declared or the interest rates significantly rise. Who decides what should be the price? There would be active managers who will be needed for price discovery, and hence active is actually it's actually complementary to passive, and passive is complementary to active. And hence, what we conclude is that from an investor's point of view, both active and passive funds have an important role to play in their financial journey. Before wrapping up, I would just highlight the possible shortcomings of this analysis. Of course, there are shortcomings, and two important shortcomings which we would highlight is survivorship bias. Of course, there are a lot of schemes which have been merged post categorization changes that took place in the industry, and hence we are seeing some survivorship bias. And there has been certain style shift due to recategorization, and hence some schemes would have shifted their categories, and hence that might have led to some problems in the data. But these are the two broad shortcomings in the analysis. But in fact, the key thing to note is that we believe a lot of these shortcomings are very limited in categories like ELSS, where clearly we've seen the active funds doing very well. With that, I will stop here and go for questions if there are. Thank you.
All right, almost running out of time. One quick question, very quick one. That's coming for you, Vinay. I hope you can hear us clearly. Can you hear us, Vinay?
Yeah, Mr. Vinay. Chinmay here. Nice to see you again. I hope you're doing good. Yeah, Mr. Vinay, how do you consider BAF as a category beating the ETFs? You know, there is active management there, and on the other side, it's very passive. How do you typically answer that? Thanks.
So can you repeat last part of your question? You said what's the view on BAF? But can you please repeat the last part?
BAF versus ETF.
BAF versus ETF.
That's right.
Okay. So I think the way to look at the balance advantage fund is that these are funds which actually are extremely suitable for an investor who just wants to save money. He doesn't know whether he wants to invest in equity, fixed income, which sector, where, etc., etc. The idea is that these type of funds generally take valuation calls in the market. So when the markets are cheap, they tend to invest more in money in equities, and when markets are expensive, they tend to sell in the market and invest that money in fixed income. Remember, while all of these appear very simple on paper, it is extremely challenging to do this because of emotional constraints. Just think about who would want to go out all guns blazing in March 2020 and invest a large proportion of their savings in equities. I would say it's very limited because of the scare at that point of time. But if you notice, most of the balance advantage funds actually did that. And the same thing, these funds actually reduced their equity exposure in the last year when the markets were doing very well, and it was extremely difficult to sell because everyone thought that this is the only place to make a lot of money. So to summarize, while technically you can do well by doing your own asset allocation using ETFs, But balance advantage funds actually, due to the active management, are able to provide service because of the emotional discipline they try to bring. And hence, I think these are reasonably attractive products for amateur investors.
Thank you so much. Thanks so much.